Welcome to the market update for August 2025. I have Tony and Vaughan with me to give us some insight into what's been happening over the past month.
Hi Jordan, hi Tony. Yes, it's
Hi, Vaughan.
it
Hi,
was
Jordan.
another good month for the portfolio in August. U.S. equities hit multiple record highs with the S&P 500 and the Dow, but it was actually small caps in the global market and in Australia that started to outperform. And one of the things that we've been talking about and that we'll touch on today is just the valuation difference in terms of the PE ratios of top companies in the market. So in the ASX 20, for example, here, and also at the top end of the US market. And Tony, that's something that we've been discussing recently. We've got a little slide to show as well about how PE ratios across the ASX are trading a little bit higher than long-term historical averages. But that is certainly being dragged up by a small handful of companies. And towards the mid and small cap end of the market, there's actually a lot of good value there at the moment.
There is, there is. If you're just looking at, say, for example, buying an index fund, and you got the ASX 200 index fund as an example, you'd be saying, "Well, where are you going to get value at the moment? The market's quite overvalued." So if you have a look, this is the All Ords 500 index, but we've got market valuations there at 21.8 now. If you can see the yellow there, the average is actually 15.4. Now, if we take out, for example, companies like CBA, Telstra, and even CSL, which got hit really badly over the last month or so, they're both trading. If CBA is still, I believe, the most expensive bank in the world, it's trading at around about 28 to 29 PE ratio. Telstra is up at around about 27. So if you think of the banks, I mean, even for example, Westpac, I believe, is even quite high PE ratio. It's currently trading at 19.3, where the bank's average is usually around about 14, 15. So from that perspective, if you take out your Commonwealth Bank and you take out your Telstra, and which from Commonwealth Bank takes up over 10% of the index, Telstra is pretty high up there as well. So if you take them out of the equation, you've actually got some good quality stocks that have been ignored because of the flight to safety, which is understandable when markets are volatile. There is always a flight to safety. And it's hard to, if you've got some, very large capital gains and you've got a decent tax bracket, it's hard to sell some of your shares like CBA, to maybe lock in a profit and be able to buy them back maybe a bit cheaper in the future as well.
Right.
The
Yeah.
market being so concentrated. And it's the same in the US, Vaughan. I don't know if you got the US slide there, if you can bring
Yep.
that up. Thanks, Jordan.
Yeah, it's certainly we've already started to see a little bit of a rotation towards a bit more money flowing into the small and mid cap in the Aussie market at least, and I think this graph as well paints a fairly similar picture as to what's happening in the S&P 500 and US markets. So
Same scenario. You got 22 times the S&P 500 and the Nasdaq 100, 28 times, and the Nasdaq's very tech heavy, as we know. No, I've had exposure to the Nasdaq 100 personally for around about 7 years. When you actually have a look, if you strip out the Magnificent Seven out of the S&P 500, you got 493 other stocks. And even if you go to the sort of that mid cap, and remember, a mid cap in the US is like a large cap here in Australia. From that perspective, but you've got a lot of the mid cap and a lot of the small cap, which just have been ignored because of the exceptional growth that you've seen in stocks like Nvidia, and not just your normal favorites of your, Meta being Facebook or Alphabet being Google and Amazon, etc. So from that perspective, you strip them out, and if you have a look at the PE ratios, they're probably once again trading around about the 15 to 17 mark, which is the normal weight when you strip them out. So there is some real opportunity, and Vaughan, I know you'll touch on, but we've been really taking advantage of that opportunity as well, and moving some of and thus the portfolios have been very robust during this period.
yeah, that's right. And I think we've seen that investors have been prepared to pay a slightly higher price in terms of the PE ratio for some of these top mega tech companies, and that's why they are consistently trading a little bit higher than the longer term historical averages. And that's something we discussed yesterday in the investment committee meeting around the potential of AI and the amount of unknown that is being priced in, because the rate that this technology is developing is unlike anything we've seen before. And so the PE ratios at the very top end of the market, which are tech and AI-based companies that are pumping a lot of resources into that, they're trading at a really high multiple, which is skewing the overall market average PE. But then if you look at the mid cap, the Russell 2000 index and the 400 mid cap index we just looked at as well, they're basically bang on average long-term valuation. So the market overall really doesn't seem to be too toppy, despite, of course, some really high PE ratios at the top end. And on the global side, we've been including some mid cap funds over the course of the year. We increased our exposure to an Australian small cap fund on that basis last month, and it is something that we're looking at. Is how much exposure to small and mid cap funds within the whole ASX sleeve of the portfolio do we have? Because it's one thing being in an ASX small cap fund, but you do have to be strategic about it. You don't want to purely be in the index, because the further you go down the index and the smaller market cap that you take on, it's not all great stuff. So
100% correct.
we wouldn't be so inclined to have a purely index exposure for an X200 fund, for example.
Well, we saw one company yesterday, which we were discussing, a mining exploration company that has an entire market cap of, I think it was $4.3 million. That's its valuation. And we saw another one that had a market cap of $30 million and only turned over $35,000 and made negative $361,000 in cash flow. Six employees. From that perspective, I don't want that in my index fund. So and that's where you have the specialist managers who will say, well, sorry, they're going to be totally filtered out. They're not even going to make our filter or research from that perspective.
Yeah, and it's a valid point as well in differentiating between Australian small and mid caps and US small and mid caps, because as you said, you take a S&P 500 mid cap in the US, it's probably going to be a top 10 or 15 company in Australia.
Yeah, definitely top 15.
Yeah, even if it's number 450 in the US, so that's something as well to consider. But so we'll be looking at rotating into more small and mid caps in the Australian and global side. But the only change we made.
Sorry, Vaughan, I'd like to just add, I think there's one thing also to consider there is the US most likely will have an interest rate cut, probably 25 basis points. I doubt it'll be 50, even though there seem to be like a 3 or 7% chance, or what I would call hope of a 50 basis point cut, which I can't see. But, Melbourne Cup coming up in the first Tuesday in November here. We'll probably see a 25 basis point interest rate cut as well here in Australia. And on that basis, that's only going to benefit these mid-cap companies, who do have debt because they've gone for infrastructure builds or, buying other businesses and things like that. So they do have debt. So an interest rate cut's only actually going to be more beneficial even for these mid and profitable small cap companies. And same obviously in the US with interest rate cuts over there as well.
Yeah, that's right. So expectations for rate cuts are still, as you said, quite high in the US. They've eased a little bit here, I think, since the pause in rate cuts that we had probably about a couple of months ago now. So this graph shows rate expectations. In the green is US Fed implied rate, and you can see that there's over the next 18 months, there's about 1.5% is priced in terms of rate cuts, down to about 3% by next September. And then in Australia here, you can see it falls to around about 3% by May in terms of the implied policy rate, and then flattens out. So we've already had 3 rate cuts, and the market's expecting the next one, as you said, on Cup Day. So the impact of that is historically more beneficial towards companies that are a little bit further down the market cap. But the only change that we made to the portfolio yesterday is just continuing what we started last month in just deploying a little bit more of the UBS cash fund holding that we've had. So in this period of higher rates, we've held on to a little bit more cash in the UBS cash fund, which has been a solid yield over that period. But in line with our expectations of what we think is going to continue happening with rates. We're just deploying that into the realm short-term income fund, which the target and historically what it's done is around about 2% above the RBA cash rate. So that's just a small change we've made in the
Very
short term.
very solid and consistent performer as well.
Yeah. Yeah. So the UBS cash has served its purpose, but just that the environment is rotating again. So we'll move out of that.
Yeah, no, so it did serve its purpose well. I mean, when we had some volatility, it was a risk-free 5% yield basically come in on it, and during that period of time. But interest rates have now started to drop, even though you're still getting a risk-free rate there. You can now move into the realm, which obviously does have a bit of risk because it's income and got bonds in there. But as we said, with interest rates looking at coming down, we believe that risk is mitigated substantially.
And it's shorter term duration bonds we're looking at as well, because the longer term bonds, there's a little bit of doubt as to how they'll hold up over this period, particularly if rates fall in the US. But then if inflation hangs around and this tariff-based inflation that's spoken about, if those two events do coincide, that's not going to be good for longer term bonds. So that's why this new fund that we're going into is a short term duration income fund. So that's the only change we've made at the moment.
Yes, so the end of August figures were once again extremely positive. 12 months rolling 2 years and rolling 3 and 5 years or since inception, all been very, very positive and above benchmark, which we're very happy with. In respect to the results, ESG funds have been star performers, and the first 11 odd days in September have also been pretty good for us as well. Once again, above benchmark and peers and doing quite well.
Thanks, Tony and Vaughan. We'll cut it there.
Thanks, Jordan. Thank you, Vaughan.
Thanks, Jordan.
The Kofkin Bond Market Update is a product from Kofkin Bond and Company, which we are an authorized representative of Count Financial. All information in this market update is for education and entertainment purposes only. It is not intended as a substitute for professional, finance, legal, or tax advice. The hosts of the Kofkin Bond Market Update are not aware of your personal financial circumstances. Before making any financial decision, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from the market update. For more information, head to the disclaimer page on the Kofkin Bond website, or you can find resources on the ASIC website and find a registered financial professional near you. In the spirit of reconciliation, Kofkin Bond and cohorts and the hosts of the Kofkin Bond Market Update acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past,